Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora koutou and welcome to another week of Markets, Mystics and Mayhem. There's still a little bit of mayhem in markets, so we've pulled three mystics together to talk our way through what's happening, particularly deciphering the data. And in New Zealand, one of the most important data points we get is the labour force. You see, every economist learns the Phillips curve, which is the relationship between unemployment and inflation, and we got more insights into not only unemployment but the strength of the labour market, and everything that is going on in New Zealand right now has been reflected in our softening labour market. So let's get into it. MJ, the numbers, what did they say?
It was basically a continuation of the themes we've seen in previous reports, where the labour market is still very soft. Unemployment rate was held steady at 5.1, but that's because the participation rate continues to fall. But like you say, every other indicator within that report just pointed to this weakness, just a lack of appetite really for labour. Employment barely grew. The full-time workforce is shrinking. Total hours worked is down, and then also reflective of a change in or a shift in bargaining power back towards the employers. Wage growth is moderating. So there was really, you'd be hard pressed to find any sign of an improvement there.
Yeah, it was the hours worked falling 3% on the year really sort of stuck out to me. And on top of that, you've got wages cooling. So, there's, I guess, good news for businesses, but not for households.
Yeah, it's just, part of it is that inflation is back at around 2.5%. So there's, less reason to see big pay increases, but also just growing slack in the labour market because there's just no demand for labour anymore. Again, that bargaining power is shifted back to employers. So it's all signs of a weak labour market, which points to potentially weak activity, especially the hours worked.
So
being down.
Sometimes we've got this chart, it'll probably come up right now, of total hours worked and GDP. And sometimes we say total hours worked is a good sort of leading indicator of what economic activity is doing over the quarter. We ended last year sort of on a bit of a high. The Kiwi economy recovered quite a bit. I think expanded 0.7% over the quarter. Now, though, that total hours worked is still declining. So are we still seeing that as a leading indicator that maybe this March quarter activity is also going to maybe post a bit of a decline?
Maybe not so much as a decline, because we are starting to see other indicators showing a bit of a lift in activity. But I think it'll be a very subdued activity, a subdued quarter for economic activity. Labour is very labour-led kind of economy, and that does feed into the GDP report. So this doesn't point to a big increase in the March quarter now.
Which just shows that things aren't taking off yet, and we're still in this environment where rates are still restrictive, but the economy's still not really gaining any speed whatsoever, and actually we're starting to get more downside risk to inflation.
Yeah, absolutely. If you look at the data, the labour force or the unemployment rate tends to lag. So it has risen and reflects what was happening last year, that deep recession of last year. And we're all looking for turning points, and they're not quite there yet. If I think about the anecdotes that I get from businesses that I speak to, that they're still telling me that they're shedding hours, they're shedding workers, even though their outlook may have improved a little bit. And then we had Liberation Day, and now we've got all this talk of tariffs overseas, and what does that mean for our export sector? So we've been crawling out of this recession. We still have restrictive monetary policy, to your point, and now we've got all these downside risks.
Yeah, I think that shift in quality between full-time and part-time employment is very indicative of a very tentative recovery. You saw that during the 90s, you saw that during GFC. As you're kind of coming out of a crisis, you're a bit more cautious about hiring. So you'll start with, a part-time worker first, see actual demand for your business rise, and then you'll, think to increase your headcount more permanently. But this is very indicative of a tentative recovery, which is what we're seeing.
And the demographics of the labour market is interesting, like this kind of first in, first out
Yeah.
thing. Can you explain that?
Yeah. So as MJ said, a lot of the reoccurring themes of previous sort of labour market releases, at least over the past year, have played out this time around as well. And that is, who's bearing the brunt of this. And it's actually, your younger employees, also your older kind of employees too. But particularly, the young workforce, I think, out of the, what was it, 20, oh my goodness, what
20,000
20,000
in employment.
Half of that was made up of, young workers. So, and why is that? Well, when the labour market's quite tight, younger workers are sort of enticed into the market, but in the reverse, now we're seeing that they're often the first out, pushed out as well.
And where are they going?
Well, some of them back to school, which is, good for them coming back into the market later down the line. Some of them, it could just be, that shift to overseas. It's easier to just find work somewhere else, like Australia, whose unemployment rate is, a whole % lower than us. And actually, at the same time, you're also seeing that not an employment, educational training statistic that's also increasing as well. So you've got people who maybe they're just so, I guess, overwhelmed with the current state of the labour market that they're actually not sure what to do right now, and they're just sitting steady for now, maybe seeing what to do next.
But you mentioned a good point. So it was what the Australian labour market is a full percentage point below ours. Is that the unemployment rate's a full percentage point?
The unemployment rate, yeah.
So that spread is a very good indication or a very good driver of migration. So what's happening with Kiwi migration?
Well, it's definitely lost a lot of its lustre than when we saw in 2023. We had the year of record-breaking net migration growth. Now that's starting to slow down to, I guess, its long-term average of around 30,000. And what's really driving that is, well,
30,000 inflow of migrants.
Yes, yeah. And what's really driving, the sort of change in net migration is, well, you had departures really ramp up. Again, it's all mainly labour market driven. And then on the other side, you've also seen migration arrivals have slowed as well. Probably also indicative that there's just not a lot of jobs here. Migrants do need the jobs for their visas. So, we are seeing quite a cooling in that space.
Yeah, absolutely. And we're hearing that on the ground too. So I heard, I think it was late last year, from a CEO of a company looking to hire quite a specialised engineering role, put the ad out there, had sort of 55, 60 responses, which was way more than he was expecting. Most of them were migrants, and he said some of them were very aggressive and very desperate in trying to find a job, which was quite a telling sign. And then the Kiwi migration story is it happens. It happened with the mining boom in Australia 10 years ago, and it's happening again now. Aussie's just a more attractive country in times like this, so people are jumping the border. We've got is it a record net outflow of Kiwis?
It's probably pretty close to that.
Yeah.
And it is of a younger cohort as well, leaving the country. We're talking about youth unemployment rates, and our youth unemployment rate, which is youth is like considered 15 to 19 years old, kind of straight out of high school. But our unemployment rate for that cohort is 23.9. In Australia, it's 14%. So
if you do a bigger spread.
Bigger spread. If you look across the ditch, they'll just, coming out of high school, they'll see more job prospects over there. So you just see that flow of people.
Yeah. And Australia, of all countries to go to, Australia is the easiest, right? Their culture is very similar to ours. Great sense of humour, great banter. It's a very easy country to move into, I know personally. They just support the wrong rugby team. So we've seen hours worked drop. So businesses are cutting hours, and wages also coming right off. Where do we see that going, and what does that change in your inflation outlook?
Yeah, well, we've seen just a continued fall or easing in wage growth comes off the back of inflation, overall cooling, also just no demand for no demand for labor, so there's less competition out there. So there's, we've seen wage growth fall to I think 2.6% year on year, down from its peak of around 4.5% year on year. So it's been quite a big cooling. The distribution of that is really interesting as well, because I think 59% are receiving a pay rise, which is much fewer than the 66% this time last year receiving a pay rise. And then within that, fewer are getting a pay rise of something over 5%. They're getting more of a pay rise between 2 and 3%. So you're seeing a cool down in those wage measures as well.
And that came in below our forecast. So I think that's a key bit of information that's slightly weaker.
And below the Reserve Bank's forecast too.
Exactly.
Yeah.
So even though, because I think, when you first see the headline came under our forecast, also the Reserve Bank's forecast, I think they had 5.2, right?
2.8.
No,
Wait,
sorry, for the headline.
Oh, yes.
For the headline, it was 5.2, right?
Unemployment.
For unemployment. And then on the wages side, they had 2.8. So, it's kind of a bit of a balancing of, okay, unemployment wasn't as high, but all the other indicators showed the weakness. And then the wages in particular, which is the part that probably matters the most for them because it's that inflation driving part, especially for the domestic wage inflation, that's come in quite a lot lower.
Yeah.
So what does that do to our non-tradables forecast, domestic inflation forecast?
Probably hitting lower. So, I think it really justifies our case for, monetary policy being too restrictive now, still in restrictive territory. And actually, if you've got this downside risk to your inflation, your non-tradables inflation, then, the cash rate can actually go below that neutral rate. We probably actually need to start stimulating a bit when you see everything that's happening in the labour market.
Yeah. So I think we've grown in confidence that non-tradables is going to get to 3% or slightly below. And all the domestic indicators that we have suggest a softer domestic inflation story. So that's the most important for the RBNZ. But then tradables, like with all these tariffs and that going on offshore, we're more of the belief that it's a disinflationary force that will come through and push headline inflation below 2. Why don't you?
Yeah, so all of those indicators, that what's happening overseas, a weaker labour market, it points to medium-term inflation being potentially below the Reserve Bank's target of 2%. So again, that's just it's a case for lower interest rates to support economic activity and to see inflation stay at 2%, because you don't want it to go below. You don't want to go into that sort of deflationary territory. Not that it will, but the risks are tilted towards a weaker inflation print than stronger for us.
So, okay, weaker inflation. We have monetary policy which is restrictive, which still baffles me, still winds me up. We've got a cash rate of 3.5. We know neutral is closer to 3, and we're still in restrictive territory. Given the recession we've been through, all this weakness that we talk about, the Reserve Bank's monetary policy setting is still restrictive. So every economist thinks that they're going to cut to 3% or below. We would argue they should do a 50 basis point move in the May meeting just to stop mucking around. But our argument is that we need to go to 2.5% on the cash rate, get into that stimulatory territory. What does that mean? Well, mortgage rates have moved quite a bit, but the money markets are only factoring in a cash rate falling to 275. So if we're right and they cut to 2.5, there's more downside for all interest rates in this economy. If we're wrong and they only go to 275, well, current mortgage rates like the 499 on the 2-year probably about right. And if we're all wrong and they stop at 3, well, then that 499 rate would look pretty good. So we definitely think that in the May meeting they're going to change their stance. They have to when they update all their forecasts. And in changing their stance, they're going to have to lower their OCR track.
Yeah. And in thinking that in the most upside scenario there, where they say they pull down the track to 275 and they keep it there, and 499 becomes kind of the rate, and we don't see much below that, is it just a situation of the rates holding at that low level for a little bit longer than than we previously thought, even if they don't, put the track even further down.
Yeah, I think we'll still be banging the table for a 2.5 rate, even if they only go to 275. They're still moving closer to our view rather than the other way around. But let's say they stop at 275, then that 499 rate just holds for longer, and that's important because people are rolling off. So as people roll off and go on to these rates, the effective mortgage rate, the effective amount that people are paying keeps heading lower, and that's the financial relief that households need.
There is also that case that you sometimes bring it up, if they're expected to get to 3% at least, right? What's 25 basis points more? You usually would cut a full 50 from 3 to get to 2.5. Maybe not all in one go, but if you really want to provide some stimulus, it's not just 25 basis points. It's half a percent. Yeah,
completely agree. Absolutely. So if we're confident that 3 is neutral, which we roughly are, then like you say, 25 bips. What's that going to do? 50 at least. And that's how we get to 2.5, basically. And then I guess our story of all of this happening, all these rate cuts coming through and being fed through, how confident are we that we're going to get this bounce in the second half of the year? Because, we've been factoring in, trusting the process, as you said, rate cuts coming through, feeding into the second half of this year. What's the chances that story just has to be pushed out?
So say we, do get to 2.5% cash rate. In that case, I think it's pretty safe to say that conditions are pretty set for the economy to recover, over the second half of this year into next year even. But of course, there's also that downside risk coming from offshore. And really, I guess the recovery is kind of hanging in the balance of what happens offshore as well. Just with tariff situation, the uncertainty and the prospective global slowdown that could fall out from this as well. So I guess what are we still seeing in that space? Because we're starting to see deals being made, off a very slow start. We've got one deal with the US and UK. Maybe hearing from China. Don't know how soon we'll get something out of there. But I think, seems like things might be getting better, but is there still potential for it to push out the recovery even further?
Yeah, I think so. I think we'll still be in a world where high level tariffs is the norm, even when these deals are done, which just means a slowdown in global economy, which hits us here. So there is risk that we see the recovery that we were kind of expecting. We're kind of seeing a bit of that start to happen. If you look at current activity indicators, they're starting to turn. So if it wasn't for these tariffs, I think we might have seen this lift in, this rebound in the second half of the year. But it does offer a big downside risk to those forecasts.
Yeah, especially because even if we do get some good deals, like I know we can't use the US UK as a baseline and blueprint for all the deals to come, but I guess if you look at part of it, that 10% baseline tariff is still holding for them. That's still clipping the ticket on global growth a bit, even if it's not as high as other tariff rates, that still clip the ticket. You're going to have lower growth as a result. So yeah, definitely does add to some risk there.
Yeah.
And the reason we can't use the UK as a template?
Because the UK has a trade deficit compared to runs a trade deficit with the US.
With the US, yeah.
Whereas, other countries that have a trade surplus with the US might get hit a bit harder. I think Trump doesn't really like that. He wants to take a bit more control back there. So I think it's very likely that he might demand more from those nations and they might not get as low as, a good as deal.
There's no way the tariffs are going back to zero. We need to make that really clear. Part of the agenda is to actually shift trade and try and rebalance things. But a big part of Trump's agenda is generating revenue. And generating revenue, taking a 10% clip on everything, will do that. And he wants to reduce income tax elsewhere. That's what this is all about. So yeah, I mean, it's great that we've got a deal with it. We've seen a deal between the US and the UK, probably get something with Japan and others. It's still taking time, and that time is hurting growth, and I think it's hurting our forecasts, right? We do have a forecast bounce in the second half of this year, maybe it just, takes more time. Some of that shine that we've seen in the external sector gets taken off.
Yeah. The longer this takes, the further away we get from seeing an upside scenario play out. So
Yeah. And the more reason for policy to get down to 2.5 and get down there quickly.
Yep.
To sum it up, things were starting to look a bit better, at the beginning of this year. Tariffs obviously complicates that. And you're still seeing, a labour market that's reflecting the scars of the recession that, as you say, we're crawling out of. And, even though we do see this and expect a recovery, in the second half of this year, there is still, risk to that outlook. But overall, if we're looking at the domestic picture, what the labour market tells us is that the Reserve Bank, can do more and should do more, and we hope they will do more. And that will, help domestic conditions here. And now we just have to wait as we see what comes out of the global picture.
Christian, we won a 50 in May. Thank you. Thank you for tuning in for another week. Please like, subscribe, send it to your mates. Get involved. Thank you. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.